We all know about inflation and how it's driving up the cost of everything, from groceries to gasoline. In fact, with nearly 76% of Americans rating economic conditions negatively and 74% feeling the sting of rising food prices, it's clear that inflation isn't just a headline, it's hitting our wallets hard. So how do you protect your money and make it work for you in times like this? I'm Stephen Gage, President of Vision Commercial Development. Today we're breaking down the smartest investment strategies to not only shield your finances from inflation, but also grow your wealth despite its current status. Let's get started. One way to invest your money to protect your wealth from inflation is also one of the most straightforward options, and that's Treasury Inflation Protected Securities, or TIPS. These are U.S. government bonds specifically designed to safeguard your investments from inflation. The principal value of TIPS adjusts with changes in the Consumer Price Index, or CPI, ensuring that your money maintains its purchasing power over time. TIPS pay a fixed interest rate, but that rate is applied to the inflation-adjusted principal. This means that your returns increase as inflation rises. Available in 5, 10, and 30-year maturities, TIPS are an excellent choice for those seeking long-term stability and to hedge your capital against inflation. One thing to keep in mind is that during periods of low inflation, TIPS might offer lower yields compared to traditional bonds. Additionally, there's a phantom income tax issue that means that you'll owe taxes on inflation adjustments in the year that they occur, even though that you won't receive that money until maturity. But despite these considerations, TIPS remain one of the safest and most effective tools for inflation protection. A great way to shield yourself from inflation is investing in Series 1 savings bonds, which is another U.S. government-backed option. These bonds combine a fixed interest rate with variable rate that adjusts semi-annually based on inflation. This dual structure makes them a reliable choice for protecting your investments against rising prices. Series 1's bonds mature after 30 years, but you have the flexibility to redeem them after just 1 year, though cashing out within the first 5 years comes with a 3-month interest penalty. While they're highly secure, there's an annual purchase limit of $10,000 in electronic bonds, with an additional $5,000 available in paper bonds if purchased through your tax refund. For those willing to hold their investments for a longer period, Series 1 bonds provide a safe and straightforward inflation hedge with guaranteed returns. If you're looking for higher potential returns and don't mind a bit more risk, real estate investment trusts, or REITs, could be a great option. I have a video on the channel going into more depth about REITs that you can watch, but for a simple overview, REITs invest in income-producing real estate and often benefit from inflation because property owners can raise rents in line with rising costs. REITs offer diversification and liquidity since they're traded on stock exchanges. However, like all real estate investments, they're subject to market risk and sensitive to interest rate changes. Despite these risks, REITs can provide steady income through dividends and act as a strong inflation hedge. A simple and stable way to battle inflation through investments are short-term certificates of deposit, or CDs. CDs provide fixed interest rates over a set term, offering a predictable return on your investment. While not directly tied to inflation, short-term CDs can still be a strategic choice in an inflationary period, especially when combined with a reinvestment strategy. CDs are particularly attractive for their low risk profile. They're FDIC insured up to $250,000 per depositor per insured bank, which ensures that your principal investment is protected even in the unlikely event of a bank failure. This makes CDs a dependable option for those who prioritize security over high returns. The key to using CDs effectively as an inflation hedge lies in their short-term nature. By choosing CDs with shorter maturities, typically ranging from 3 months to 1 year, you maintain the flexibility to reinvest your funds at higher rates if inflation continues to rise. This strategy allows you to take advantage of increasing interest rates over time, rather than locking your money into a long-term CD with a fixed rate that might not keep pace with inflation. One thing to note is that during periods of high inflation, even competitive CD rates may fall short of keeping pace with rising costs, meaning your purchasing power could still dwindle over time. Additionally, CDs lack liquidity. If you need access to your funds before the CD matures, you may face early withdrawal penalties, which can eat into your returns. Inflation-linked bond funds provide a diversified approach by pooling a range of inflation-protected securities, primarily TIPS. These professionally managed funds offer regular income distribution and spread risk across multiple bonds. Inflation-linked bond funds are designed to adjust their returns in line with changes in the Consumer Price Index, or CPI. This ensures that as inflation rises, the value of the underlying securities increases, providing a hedge against the diminishing purchasing power of money. These funds make money in two ways. First, through income distributions, which are regular interest payments sent to investors. And second, through capital appreciation, meaning the fund's value can go up over time as inflation increases the value of the bonds. While these funds are convenient, expensive ratios can eat into returns, and they may underperform during deflationary periods. Still, for those seeking a hands-off way to hedge against inflation, these funds are worth considering. When inflation rises, do you know what becomes a go-to investment? Commodities. Commodities are physical goods that serve as building blocks of the global economy, such as metals, energy, agricultural products, such as crops and livestock and meat. Commodities directly reflect changes in the cost of goods. For example, when inflation drives up the cost of materials like oil or grains, the value of those commodities also rises. This natural alignment with inflation protects purchasing power, as the increased value of your investment offsets the higher living expenses. Investors can gain exposure through commodity-focused ETFs, which provide diversification across metals, energy, livestock, and agricultural goods. While commodities carry higher risk and volatility, they can offer substantial returns during inflationary periods. When it comes to safeguarding your money against inflation while maintaining easy access to your funds, high-yield savings accounts are a practical and accessible option for almost everyone. They may not directly combat inflation like tips or commodities, but they can provide a safer, low-risk way for you to earn more interest on your cash compared to traditional savings accounts. High-yield savings accounts are savings accounts that offer significantly higher interest rates than standard savings accounts. They are typically offered by online banks, credit unions, or financial institutions that don't have the overhead cost of traditional banks, allowing them to pass those savings on to consumers in the form of better interest rates. While high-yield savings accounts don't directly counteract inflation, they help to mitigate its effect by preserving more of your purchasing power. The higher interest rate offsets some of the inflationary pressure, ensuring that your money grows at a faster pace than at a traditional account. This can make them a smart option for storing your emergency fund or short-term savings while still earning a return. Inflation doesn't have to diminish your wealth. By incorporating options like TIPS, Series 1 savings bonds, REITs, commodities, and other inflation-conscious investments, you can protect your purchasing power and grow your portfolio. Remember, the best strategy depends on your financial goals, your risk tolerance, and the amount of time that you have. If you're unsure where to start, consulting with a financial advisor can help you tailor a plan that works for you. If you found this video helpful, hit that like button and subscribe for more tips on smart investing. Thank you for watching, and I'll see you in the next one.